we have 4 of 6, so I guess that makes a quorum, right? As far as the committee.
And actually, just Colin, he had a doctor's appointment. Wasn't sure he was going to make it, so he's not here. But don't worry about that. I got it.
Well, I'm going to call the meeting to order. And you've all had the opportunity to look at the agenda. Can I have someone that move approval?
Greg will move approval.
Seconder?
Second. Stephen.
Okay, Stephen. All in favor?
Aye.
Aye.
Okay. Does anyone have any conflicts of interest with the agenda that you have before you today?
No, sir.
Okay, having heard none, we can move along to the staff report on the post-closure review. Brett and Tony.
Thank you, Mr. Chair. I'll just do a quick introduction for Tony. I'll try to hit some of the high points. To get right to it, I guess the Q1 results were negative 5.1%. That's unusual given the performance over the last couple of years, but it was bound to change at some point. It really attributable to a number of factors. Obviously, we've heard it all in the news quite a bit recently, but I'll touch on them. I mean, we've got these rate increases that have been coming quickly and sort of rapidly, trying to get inflation under control. We've got some reduced spending as a result of that inflation at the consumer level. Then, of course, there's the elephant in the room, the Russia-Ukraine conflict, which has thrown all kinds of turmoil. And then as of late, and almost since we put this package together, you've got the increased lockdowns in Shanghai and other areas within China that causing some supply concerns. So that's the general explanation. One thing I would point out, and the committee's heard this before, Don used to do a really good job on this. He had a particular graphic where he was able to zoom in on market performance overall over a long period of time. He would start zoomed in on a turbulent point like 1929. But then as he zoomed out, it became very smooth, right? So you didn't have these big ups and downs, and it's important to keep that perspective when we look at the fund's performance quarter by quarter. Obviously, the horizon here is, I believe, 2036 or so, when we need to have the money available. So we're still in relatively good shape, and I'm sure Tony can speak more to that. The only thing I'll add, there was the quartile ranking for our various funds was not available at the time that we produced this report, and I'm not sure, Tony, if that's become available.
Yeah, we've been kind of tracking it through Morningstar, and they can't give an explanation. It normally is updated by this time. Every quarter we kind of update it, but that again, it's short term, so it's not that big of a deal. But like as Brett indicated, for the quarter we're down just shy of 6% or 5.8. But you got to remember the kind of the investment thesis for this portfolio in particular is longer term. So if you're focusing a little more longer term, and what we did is what's showing up, I guess I'm not sure exactly what you guys have, but our 3-year number, which is kind of where we are today. Since we've changed kind of the investment policy statement, on average each year we've returned 5.64%, which is above kind of the numbers that we're after. So, having changed it, definitely go through this volatility. We've been there before, we're there now. And like Brett indicated, the big thing here is inflation. And actually it's hit like a 30-year high. And as a result, we're seeing, gas up like 40%. I know, you look at diesel is like $2.30, and not a lot of people look at diesel, but I do. I have a trailer that I put diesel in, $2.30 a liter. It's still like almost $2 for regular gas, and so that kind of hurts everybody. Housing prices are up, labor costs are up, and what's going on now is, as Brett indicated, is the central banks are trying to tame this inflation, and the normal way that they do it is raise interest rates. But the big kind of out of the norm thing here is Nobody has really got it right, because normally it's like a supply and demand issue in that, as, demand goes up and there's less supply, as prices go up, they hike interest rates to kind of stop the spending and stop everything from happening. Well, the biggest thing here was the pandemic has thrown everything into a tailspin. And so the central banks originally talking maybe raising rates by 1.5%, 2%. Last week, they said, hey, we got to go to 3% because it is out of control. And so what that's done is it's really been a negative impact on the bond side or the fixed income side of the portfolio. What is nice is that we don't have a lot of, asset or a lot of allocation to the fixed income. We're actually sitting right now around 20%, which is about mid-range, but it doesn't impact our portfolio so much on the bond side, but it still does have a big impact on the equities because of the uncertainty of what's going on, the concern that we might see a recession, hopefully not a depression, and that's really not on the table. But if they don't get this right and calm down the markets, that's a potential possibility. So, by raising rates and even being more aggressive here last week, they're hoping to kind of slow this down. The problem is that supply or the supply chain bottlenecks that are still happening. Still try to buy a car. If you go by some of the dealers uptown, as you notice, there's none in there. And I don't know, actually, I meant to find out what Clark's, I guess, Fox Shed there now, what they're building there. But, they've taken that big parking lot that used to be full of cars and they're building something now.
Yeah, they don't need the inventory space.
What is it though? Do you know? Like,
No, I don't. I asked to see a building permit for it today, but it hasn't come forward through City Hall.
I've been informed they're building,
it's not relevant. Pardon me?
I've been informed they're building a new dealership building. They're going to take the other one down, but
Oh.
if Greg hasn't seen a building permit, then maybe that's not true. I don't know.
Well, rumors usually far exceed the speed that building permits do. So
It's a big footprint.
It's kind of, what that's doing is, it's an issue, but not because there's so many people out there buying cars, just no cars to fill the lot with, is what it boils down to, and that's not normal. There's also the scarcity of workers that are out there, scarcity of raw materials, and other pandemic-related restrictions that are causing, this, kind of inflation that is not the normal kind of cycle that we see, which is kind of a slow trend up. You raise interest rates, you bring it back down, and everything kind of resets itself. So we're hoping, and everybody is, that the central banks are getting it right, and by being as aggressive as they are, that this will be something short-term, interest rates being, up quick, but also maybe in a year and a half, 2 years, seeing them come back down. And that's really the goal. So, as long as kind of things pan out like they feel, then we're still on board and on side with the portfolio that we have. What we do like is, again, and I stress this, is we are running, about 75, 77% into equities. We do feel it when you get the volatility, because equities do, when they react negatively because of that overweight that we have. But right now, we're not feeling kind of the bond side that a lot of a balanced portfolio are. The bond side of the portfolio, or the fixed income side, is down somewhere around 7.5%, 8% since the start of the year, and we're feeling it a bit, but not as much as kind of a lot of kind of very conservative balanced portfolios. So, what we see going forward is this continued fight against inflation. The central banks, again, continue to monitor this, raising rates instead of like 0.25% each time, maybe 0.5%. We do see it bottoming out or topping out at around 3%. And as long as we do continue to stay focused on long term, we are very content and happy with the portfolio that we have, and not recommending any changes as we stand here now. So that's kind of, in a nutshell. Brett hit on it, inflation. I'm hitting on it again. It's really, can we control, kind of the price of things? And like you, I don't like to see it out there. So, that will eventually kind of stop spending, and spending will bring inflation back in line. That being said, any kind of questions specifically that I can try to address, or is there any comments somebody, would like to make?
I guess everybody's happy with what you're telling us, so let's hope you're right.
Yeah, I hope so. Anyway,
Happy may not be the reserve, it's the word for it. It's like accepting of it.
yeah, that's right. That's right. Yeah, we're here, and it is out of the norm for kind of the way the central bank are coming at this. They got it wrong, and that's kind of everything that we read, or all the kind of, if you looking back is easy. That's the problem. So what they're doing now is, okay, we can only do something going forward, and that's what's going on. So, but no, in general, things are okay from our end, and if there are no other questions, then
Okay.
we can sign off.
Thank you for your input, and enjoy the rest of the day.
Yeah, great, guys. Have a good evening.
Thanks, Tony.
Yep, we'll see you later.
Okay, Mary Kay.
Thank you, Mr. Chair. Just gonna take a second and share my screen here with you all. All right, so you should be able to see the balance sheet in front of you as of March 31st. We'll be reviewing the first quarter operating results. So starting with the balance sheet, there wasn't very many changes from the previous month to the balance sheet, so I will highlight a few of them. You can see here, cash did go up about 290,000 from February, and that really relates to the decrease in accounts receivable, meaning we collected some of those receivables that were outstanding as of the end of February. So to the end of March, we had current assets of 2.6 million. Non-current assets totaled 20.1 million for a total of 22.8 million as of March 31st. On the liabilities side, we had current liabilities of 1.1 million, just up slightly from the previous month. Long-term liabilities of 8.6 million, and then equity of 13.1 million. Very little change from the previous month to balance out to the same number as the assets, the total liabilities and equity of 22.8 million. Moving on to the income statement. So as always, we will focus on the actual year-to-date column compared to the budget, which is the green. So starting with our regional planning division, you can see for the first 3 months of the year, we had revenue of 56,000, which is exactly what we budgeted. That's what we would expect for this division. On the expense side, we had expenses of 20,000, which is about 7,600 less than what we had budgeted, resulting in a surplus for the first quarter of 36,000, which is 7,000 higher than what we had budgeted for the same time period. Moving down the page, we come to the planning and development division. So for January to March, we had revenue of 434,000. That's up about 6,700 from what was budgeted. And you can see that that comes from our other planning revenue, and that relates to the revenue that we were receiving for providing services to Regional Service Commission 8. So we provided those services for January and February. Our contract with them was up at that time. So we won't see that going forward. On the expense side, expenses are trending slightly higher for the first quarter. So we had expenses of 380,000. That's just shy of 7,000 higher than what we had budgeted. And you can see that relates to our operating expenses. And if you drill down into the details, specifically it's salaries and benefits that are running higher than what we had budgeted. But because our revenues were higher and our expenses were higher, they pretty much net out for the first quarter. So we're very close to what we had budgeted. The actual surplus to the end of March was just under 54,000. Moving on to the solid waste division. So the landfill for the first quarter had revenue of 2,044,000. That's 151,000 higher than what we had budgeted. And pretty much all of that favorable variance comes from additional garbage that we received. So our garbage for the first quarter was 1,500 tons higher than what we had budgeted. And in March alone, 1,000 of those tons were higher than what we had budgeted. So that's good news from a revenue standpoint. And then on the expense side, we had expenses for the first 3 months of 1.5 million, which was just under 68,000 less than we had budgeted. You can see the operating expenses are the big ones that were under budget, and the main contributing factor there was salaries and benefits. So we are saving some salaries for the first 3 months. You do see an overage under capital expenditures. That's really a timing thing. We purchased something earlier than we normally would during the year. So you'll see that made up as the year goes on. So to the end of March, the landfill had a surplus of 513,000, which is 219,000 higher than we had budgeted. Now, before I move on, I do want to talk, we mentioned fuel when Tony was talking, and I just want to give you an update of how the price of fuel is going to affect the landfill specifically. So far in 2022, the highest that we've paid per liter is $1.75. And we are under the provincial contract, so obviously we do get a preferred price. However, what we budgeted for 2022 was $1.20. And when that budget was prepared, that was actually substantially higher than what the price of fuel was at that time. So we were trying to be conservative. Obviously, we didn't expect the price of fuel to be what it is now. So if this price continues for the rest of the year, we could be looking at a potential overage in our fuel of about 190,000. So I'm just bringing that to your attention. It's something we're going to have to monitor for the rest of the year and manage as best we can. Moving on to the recycling, you can see for the first quarter, we had revenues of 143,000. That was 14,000 less than what we had budgeted. I know for probably 6 months to a year now, we've been talking about the price of commodities and how good they've been, and we've been benefiting from them. Well, they've started to slow down, and we're getting less for our corrugated cardboard, as well as our newsprint. So that's why you're seeing the unfavorable variance from budget. And then on the expense side, we had expenses totaling 327,000, which was 23,000 less than what was budgeted for the same time period. So overall, our recycled deficit for the first 3 months is just under 185,000, which is 9,000 better off than what we had budgeted to be. So adding the landfill and recycling together, we come up with a surplus for solid waste of 328,000, which was 228,000 better off than what we had budgeted. And then the last division is the power generation. So revenue is exceeding our budget for the first quarter. We had actual revenues of 238,000, which is 40,000 higher than what we had budgeted. It did slow down slightly with regard to gas flow in March, but the other 2 months were higher than what we had budgeted. So that's resulting in the favorable variance there. And then on the expense side, we had total expenses for quarter one of 670,000. That was higher than what we had budgeted by just under 27,000. And you can see the contributing factor there is repairs and maintenance on the engine. So overall, to the end of March, power generation had a deficit of 432,000. And you can see when you look above, we've talked about this, the major contributing factor is that second previous year deficit that we brought in January. So if we weren't factoring that in, it would actually be profitable for the first 3 months. But obviously we have to under the accounting rules. But we are 13,000 better off than where we had expected to be for the quarter. So adding all our divisions together, we come up with a consolidated deficit to the end of March of just under 14,000, which is actually almost 250,000 better off than we expected to be. So good news there. So just to give you a summary, all our divisions are outperforming their budget or right on budget. But with inflation and the price of fuel where it is, we do expect to be challenged during the remaining quarters of 2022. Any questions I can answer for you at this time?
Mary Kay, if I can, planning and development, say we have a contract that is just finished with one of the other regions.
Yeah.
But I noticed we also have a deficit on the expense side. So does that mean going forward that deficit is going to increase by an equal amount?
I expect it'll probably come back in line. We did have a couple of adjustments to salaries, and that's what's leading to it. But we do have a lot of our expenses that are incurred in the summer. So that's when the budgeted figures are going to come in as well. So it's something we'll monitor, but I don't think that's going to grow as we go on.
Thank you.
Okay. Anyone else have any questions of Mary Kay? Okay, Mary Kay, thank you very much for your presentation, and keep up the good work. Okay, moving right along. Brett, you have a staff report on tenders?
Yes, Mr. Chair. This particular tender is for the procurement of clear stone that we use in the construction of our landfill cells. So I won't go through the preamble about when it was approved, but the amount here was approved during the budget process. Excuse me, in 2021. Typically, we would evaluate these tenders using a matrix of technical requirements and so on. In this case, we simply look at the qualifications of the bidder and their ability to supply the material. So in this case, when we use that evaluation method, we ended up with a lowest bid of $128,016 that was put in by Spring Hill Infrastructure Limited. The other bid was from Meyer Construction at $165,200. I will note that when you factor in the non-refundable portion of the HST, the net cost to the RSC will be $133,501.74. And that compares to an engineer's estimate of $148,120. So there was a, as Mary Kay would say, it's a favorable variance there. Now the recommendation from staff, no motion is needed on this, but staff does recommend that the committee agree to forward the motion that's included in this report to the board for its consideration in the May meeting. That's it, Mr. Chair.
Okay, well, I guess that's the main items, unless there's we have some general comments or directions for staff. No. Then the meeting is adjourned. Thank everybody for taking the time to join us on this sunny afternoon. Sometimes these afternoon meetings aren't as good as we thought they would be in the summer. Anyway, we can get back
Thank you,
out.
Mr. Chair.
Thank you very much. Enjoy the rest of your evening.
You all.
everybody.
Thanks all.
Take care, all.
Take care.